Hey, it's Sal. So I would just like to conclude my last video on the credit crunch. I will be posting a little excerpt by a day trader that I've followed for many years now, called Oscar Carboni. In that little excerpt, he explains what is happening exactly in the short-term credit market, the relationship between corporate debt to finance their operational expenses, and the relationship that has with the money market, and why this bailout is important, why this bailout isn't just about saving Wall Street's ass, and why it has a real impact on a lot of people's savings, uninsured savings placed in the money market. So let's hear what he has to say.
Many people are saying, why give money to the rich? You're only bailing out Wall Street. Well, no, traders, they are bailing all of us out. You, me, my grandma, your grandma, they're bailing all of us out. And here is why. Let's say you go to a bank, you have $10,000. We can use larger figures. Let's keep this simple. You have $10,000. You go to any savings bank. You walk into the bank. Hi, I have $10,000. I'd like to open up a bank account. Oh, Mr. So-and-so, you have $10,000? Well, why don't you consider putting that in the money market? Tie up your money for 3 months, 6 months, 9 months, 1 year. Each level that you tie up your money for, each length, you can get a certain amount of interest, which is more than you'll get from your savings account. Hey, the guys in the bank is thinking about it. Oh, really? You mean if I tie up my money for 3 months, I can get 5% interest? And these are fictitious figures. I can get 5% interest instead of the 2% that you're going to give me if I put it in a simple savings account? Yes, Mr. So-and-so, we will do that. Well, I think I'll put it in the money market. Thank you. Well, what does that mean the moment you do that? The FDIC no longer insures that account. You didn't put it in your savings account. FDIC insured up to $100,000 per depositor, right? Well, you've chosen a money market. You've decided to take a risk for more interest. Granted, banks will tell you, and always have told you up until just a few weeks ago, money markets are absolutely safe and secure, and the worst that can happen is you'll still get your dollar for dollar back. Well, here's what happens. Here's how it ties in, how it affects everybody. Every one of those people that walk into a bank with that money, and every hedge fund and every other huge fund that instead of putting money in their savings account, puts it in a money market account, the banks take that money and give it over to Morgan Stanley's and Prudential Baishas and Bear Stearns and Lehman's, because they use that. That's corporate debt. That's corporate paper. Lehman takes the money and says to the bank, well, thank you very much. In 3 months, you'll get back your $10,000 plus your 8% interest or 5% interest we used as an example. So you went to the bank. Simplify this again. You said I have a deposit. They convinced you, or you convinced yourself, to put it in a money market, not insured by FDIC. The bank takes all that money market stuff and gives it over to these huge corporations, and they use that money to run the day-to-day operations. They run their hedge funds, they run everything that they run, they make a lot of money, and they pay back the banks pay us. Well, what happens the moment the banks stop giving money over to these huge companies, Morgan Stanley's, Lehman's, you name it? They go out of business like that. They need day-to-day money to run their day-to-day operations. What's been happening is that there's been a big run on banks. People are running the banks and asking for their cash back. I want my money back. I want it out of the money market. I'll break my CD. I want my money back. If you do that, it stops these huge firms from having money to run their day-to-day operations, and they go out of business. Now, if they go out of business and they can't pay back the banks, guess who doesn't get their money back? You and me. That is how it affects everybody. That means you can have companies of every nature going out of business. Why? Because if we let those big Wall Street firms go down and they don't pay the banks back for all the trillions of dollars of corporate paper that they get, how are we ever going to get paid? Now, what the $700 billion basically is the government stepping in and going, you know what? Boom. We're going to insure the money market accounts as well as the bank accounts. They're going to act as an FDIC insurance against your money markets. You took a risk for more interest, the government's going to cover it. In essence, the government is saying that they're going to cover any of the companies that can't perform. Now, if they don't cover those companies, we're not getting our money back out of the banking system, and it will break down. I know that's simplified, but that is the basis of what is going on here. Did you guys back there understand that?
Yes.
Can you understand where I'm going with that? I don't want to get into the economics behind it because it can get confusing, but basically that's it. You put your money in a money market or a mutual or a 401k, it gets flipped into corporate debt. That corporate payment gets paid back and you get your interest. What if they can't pay it back? The only way they can't pay it back is if banks stop giving them the money to run the day-to-day run their day-to-day business, and then they can't pay us back. The whole system breaks down.
So, I guess this was clear enough. Having said all of this, I want to state that I am in no way a defender of the current status quo. I am a currency pluralist. That is, I believe there should be numerous types of currencies competing between themselves. I don't believe in giving some agency a monopoly over the issuance of currency. Therefore, I am favorable to the abolishment of the Fed. I am an anarcho-capitalist. Remember that.